3 reasons why CPAs must avoid IRS audit representation. Cash is wonderful. Cash is king, and every one of your clients values the commodity that is cash. We know that for some, cash may be difficult to account. Having significant cash inflow can create lots of dilemmas to a business. Among the concerns is whether that business client properly, accurately, and completely reports all of its cash revenues and tax returns. Now, every accountant and every attorney knows that some business owners may be tempted to unfairly report their cash receipts, and so begins the IRS audit. IRS tax audit of business with significant amounts of cash is extremely specialized. Most attorneys wisely avoid handling these engagements. They find this area of representation to be too technical with all the accounting principles. The auditor's inquiry begins with a survey of the business tax return, changes in the balance sheet, cash T-account analysis, and other traditional accounting tools and methods. But wise CPAs and tax accountants also try to avoid these audits because of the great exposure to professional malpractice. Why? First, an experienced tax accountant, especially the CPA, is familiar with the professional risks involved in this representation. Representing to governmental authorities the facts of mishandled cash can render dire legal consequences upon the client. Yes, you could actually make that client's situation worse. At best, underreported cash revenues results in additional tax. Plus, there is a routine assessment of the IRC 6662 penalty. This penalty equals an additional 20% of the tax. But there is much more at risk here. There is also the possibility of fraud committed by the business client. A person commits tax fraud when he, she, or the business intentionally provides false information on a tax return in order to pay less tax. And for any person determined to be fraudulent, that 20% penalty is replaced with the IRC 6663 fraud penalty, which equals 75% of the tax. The earlier description defines civil tax fraud. But any conduct done willfully, which is different from intentionally, gives rise to the commission of criminal tax fraud. By the way, aside from the 75% penalty, criminal fraud is often rewarded with time in prison. Second, the CPA offers no buffer of legal protection or privileged attorney-client communications, and the CPA is not responsible for knowing the hidden legal pitfalls within the criminal tax laws. The tax return preparer is therefore not the best representative for the tax audit. And finally, the return preparer may be an unwilling participant in past fraud by creating and filing that tax document. In that common instance, the tax return preparer could be required, as part of the representation, to disclose his or her own records and even oral statements against the client's interests. Obviously, this result is also not in the client's best interests. The very best choice for representations is to engage an attorney with a tax accounting background. The attorney must be knowledgeable of procedures under Part 4 of the Internal Revenue Manual. For best results, the attorney should be hired before allowing anyone to be interviewed by the IRS. This recommended sequence allows the team to have better control over what information is shared with the IRS. Equally important, the CPA avoids the risks of how client information is shared with the IRS. CPAs and tax accountants, be smart. When clients tell you they're under audit by the IRS, they want your help. They want your guidance. Refer them to a qualified tax defense attorney and protect yourself from the unknown.